January of last year, H.R. 1 for comprehensive tax reform, and as of today, it still shows H.R. 1 is reserved for the Speaker. Instead, today's hearing is about borrowing more money from the Chinese to maintain some very complex corporate tax code provisions that depend upon their very complexity to work. The controlled foreign corporation provision and the active financing provision are all about this Congress picking winners and losers rather than leaving the marketplace to decide. They lower the effective corporate tax rate for some businesses and say to some businesses that they don't have to pay as much for the cost of our national security and other vital services as their neighboring corporation that is competing and paying a higher effective tax rate. Mr. Hungerford, I want to ask first about the active financing provision. We understand that that would take borrowing about $70 billion of additional debt over the next 10 years to maintain. Under existing law, if a financial institution makes a loan to a domestic corporation, to one of Mr. Stallman's farmers, to a company that's making it in America, manufacturing here, as I understand it, it reflects in its corporate tax return the interest that it earns from extending the loan, and it deducts whatever the cost of extending that credit might be, and it pays taxes on the difference. Is that right?
That is correct, and thank you for asking a question of me.
If it is a loan or some other form of credit to a company that's not making it in America, that is a foreign operation, then it can take its expenses now for extending the credit, and it can take its profit on its earnings whenever it feels like it. Isn't that essentially what the active financing provision allows?
The active financing exception is an exemption to Subpart F, and if this income was all considered Subpart F, it would not be. It would be taxed immediately.
Yes, and the very fact that we're talking about Subpart F and the exception to Subpart F and active financing, and whether it's active or passing, or is the kind of thing that does add complexity and causes the eyes of most people to glaze over rather than to look at the effect of what the provision is, which is to provide, is it not, Mr. Hungerford, a substantial subsidy to encourage the export of American capital and American jobs rather than to invest in making it in America.
Yes, that is correct.
And as far as the controlled foreign corporation provision, the CFC look-through exception is concerned, another $10 billion that we would borrow from the Chinese. If you have two companies right next door to each other, and one of them can afford a bunch of fancy accountants and consultants and high-priced lawyers to rig up some corporate fiction that they've got a subsidy in the Bahamas or Bermuda, they can license their their patents, their copyrights, perhaps their trademark name to a tax haven company and strip off earnings that they've had right here in America that their smaller neighbor doesn't do. And the effect of that is to lower their their profits by increasing their costs in some tax haven. Isn't that the way it works?
Yeah.
And in fact, under using both of these devices and many other complex provisions, over the last decade, I believe GE has not only lived better electrically, but they've managed to pay an effective corporate tax rate of less than 2%, 2 cents on the dollar, which is a deal that any hardworking American or business would love to have.
That's correct.
They've essentially repealed their taxes, except at a certain minimal level. And under these controlled foreign corporations, you actually end up with what many people have called stateless income. How does that work? And how does some income just never get taxed by any entity, either here in America to contribute to the cost of our national defense or by anyone else?
Well, I mean, part of it is through the CFC look-through rule that income can be shifted, that is, from a high-tax country, high-tax foreign country to a low-tax foreign country and in such a way that it's not taxed in that high-tax foreign country, and the transaction is not taxed by the United States. So
All right,
essentially,
time
it's a
has
state-
expired.
Thank you, Mr. Chairman.